Okay, this is the Chapter 7 exam review of the most missed questions. First question, ABC Company borrows $38,000 on September the 1st of year 1 from the Valley Bank. So they borrow the money right here of year 1, and ABC agreed to pay interest annually, that's important, annually, at the rate of 9% per year. The note issued by ABC carried an 18-month term. So it starts right here in September of year 1, goes through year 1, all of year 2, and ends in February of year 3. All of that amounts to 18 months. Based on this information, the amount of interest expense appearing on ABC's year 1 income statement would be what? Year 1 is right there, right? So we've had 1, 2, 3, 4 months go by. So the amount of interest will be 9% and $38,000 times 4 months, and we've got interest expense of $1,140. Now, the fact that it's an 18-month note does not affect the year 1 interest. Like I said, it's just only going to be for these 4 months because that's all of the interest that has been accrued at that time. Next question. ABC issued an interest-bearing note with a face amount of $25,200 and at a stated interest rate of 8% to be to the Metropolitan Bank on August the 1st of year 1. When I say they issued a note, that just means they went to the bank and borrowed the money. Now, this is a 1-year note, and like I said, it was issued on August the 1st. And the question wants to know, what is the amount of cash flow from operating activities on year 1 of the statement of cash flows? So here's our accounting equation. Here's some cash from under assets, notes payable under liabilities, and when we borrow the money on August the 1st, we increase our cash by 25.5 and 25, oh, sorry, that should be 25.2. And also notes payable by 25.2. So just ignore this should be 25.2. So 25.2 is what we're looking at that we borrowed. And so when you borrow money, what I want you to see here is that you increase an asset and increase liabilities, and the cash flow involved is not an operating activity, it's a financing activity, because an operating activity would be something to do with the income statement. So apologize for this $200, should be $200 right here on this. Let's see what else we've got here. Non-operating activity, and no interest was paid on year 1, so therefore no cash flow was related to this interest. That's the end of that problem. Next, we've got ABC Company issued an interest-bearing notes payable with a face amount of $8,400 and a stated interest rate of 8%, and that was to the Metropolitan Bank on August the 1st, year 1. Note carried a 1-year term, and based on this information alone, the amount of total liabilities appearing on ABC's balance sheet at the end of year 1 would be what? So here is the end of year 1. We borrowed the money on August the 1st, and we borrow $8,400. And so here's the way I would work this. I'll show you 2 different things here involved, so maybe you can see it in one of these. So the total liability for the note is going to be the principal of the note, which is $8,400, plus the interest that we're going to owe at 12/31 year 1. So that's going to be the total liability, interest at 12/31 right here, and the principal. So we need to figure out how much interest is going to be for these 1, 2, 3, 4, these 5 months. So determine the second step in this question, the problem to answering this problem would be determine the interest on the note at 12/31 year 1. That's going to be $8,400 times 8% times 5 months over 12 months. And that's going to be $280 worth of interest, and it's going to be payable. We won't actually pay it then, because we won't pay it until the 1-year term is up, which would be over here, it'd probably be over here in August of sometime in year 2. All right, then we have a total liability at 12/31 of year 1, which again is right here, would be the principal on the note, $8,400, plus the interest on the note that we owe, but we're not going to pay until the note is due 1 year from August the 1st, which would be July 31st, year 2. That would be a total of $86.80. Now here's another way to look at this using the accounting equation. So let's see what we've got here. Okay, so if you put down cash, and put in the accounting equation, put down cash on the asset side, put down notes payable on the liability side, and also interest payable on the liability side. When you borrow the money, you increase cash, the asset, by $8,400, and you also increase a liability by $8,400. That's when you first get the money on August the 1st. At the end of the year, you will accrue interest, that is, show interest that is earned, that we owe as of 12/31 for these 5 months. And so what you'll have is you'll have an increase in interest payable based on the calculation we made right here, $280, and that will increase that liability by $280, and you'll also have a reduction under equity of $280. Keep in mind that this plus $280 for increasing this liability and this minus $280, which decreases expenses, equity right over here, makes this side of the equation stay in balance. And so the answer again is just they want to know what the total liabilities would be. It would be under liabilities, it'd be notes payable and interest payable. The total would be $86.80. The next question. ABC Company borrowed $28,000 on April the 1st of year 1 from the Titan Bank. So they borrowed the money right here, $28,000. The note issued by ABC carried a 1-year term and 6% annual interest. ABC earned cash revenue of $940 in year 1 and $900 in year 2. Assuming no other transactions, they want to know what's the amount of net income on year 2 of the income statement. So we're looking at right here, year 2. What's the income going to be? Net income, that is. So again, we borrowed this money right here, $28,000, on April the 1st of year 1. And we're going to have to look at revenue for year 1 they gave us, which was $940 worth of revenue. And they also told us that in year 2, revenue was $900. Now, some of this, like this 940 here, is really irrelevant because all we care about is what's going to be net income for year 2's income statement. So there's a revenue right there. That's part of the equation, and then we're going to figure out interest for this time period in here for year 2. So the interest for year 2 is going to be $28,000 times 6% times 3 months. And let me show you how we got the 3 months here. This is a 1-year note, okay? Which starts on April the 1st of year 1. It goes from April the 1st all the way to March 31st of year 2. So these 3 months are the only 3 months we're going to have an interest expense in year 2, which is going to amount to a total of, again, $420. That $420 interest expense and the revenue will be combined to get net income because there were no other transactions other than these 2 revenues and this interest expense. So the revenue in year 2 is $900. The interest expense in year 2 is $420, and the net income, which is what we're looking for, would be $480 in year 2. The next question. ABC Company borrowed $22,000 on April the 1st, so we borrowed the money right here from the Titan Bank. The note issued by ABC carried a 1-year term and an 8% annual interest rate. ABC earned cash revenue of $880 in year 1 and $900 in year 2. Assuming no other transactions, the amount of cash flow from operating activities that would appear on the year 2 statement would be what? So we want to know in year 2, what would the cash flow be? So let's see if we can figure this out. So there's the $22,000 we borrowed on April the 1st of year 1. we had revenue in year 1 of $880, and in year 2 we had revenue of $900. And then, like I said, on March 31st, that's when this note ended, because it was a one-year note starting April 1st, ending on March 31st. And on March 31st, year 2, we paid back the note, which is $22,000, and the interest we also paid back. So the whole note was all done and taken care of as of the end of March of year 2. So if we take $22,000, which was the amount of the note, times 8%, the amount of interest that was paid on this note was $1,760. And in year 2, we had the $900 worth of cash inflow from revenue right here. $900, I told us that. And $760 was the amount of interest that we paid. Since we paid all of this interest, all of it, in other words, we didn't make any interest payments right through here. We only made the interest payment at the end when the note was due on March 31st of year 2. So the entire interest is going to be cash outflow under year 2, along with the interest, the revenue, which was inflow. This gives us a total cash outflow from operating activities of $860. So that's the answer. And the repayment of the principal, that $22,000, is not an operating activity, it's a financing activity because it reduces a liability. This $1,760 interest is interest expense, and it goes on the income statement, and anything that goes on the income statement is going to be an operating activity. Oh, I haven't mentioned this before, but I wanted to let you know that I have a brother, and he lives probably a little bit north of here, and his name is Hal. My name is Al. His name is Hal. I wanted to share that with you a little bit. Here's a picture of my brother Hal and his new bride when they got married at their wedding. That was, I think, maybe last year sometime. And while they were on their honeymoon, they went on a hunting trip, and I wanted to show you a picture of that. Here they are still on the honeymoon. It's a nice picture. You can see something on the honeymoon trip there. That's while they were hunting. And now back to question 6. ABC borrowed $22,000 on April the 1st, year 1, from the Titan Bank. This is beginning to be a familiar theme here, isn't it? The note issued by ABC carried a one-year term, 8% annual interest. ABC earned cash revenue of $880 in year 1 and $900 in year 2. Assume no other transactions. They want to know this: the amount of total liabilities that would appear on ABC's December 31st balance sheet for year 1 and year 2. So let me repeat that. The question wants to know the amount of total liabilities that would appear on the ABC December 31st balance sheet for year 1 and year 2. Well, let's get out our accounting equation, and let's record on 4/1 the company borrowed this $22,000, so cash goes up $22,000, liabilities go up $22,000, and that's because we issued a note. And then during year 1, looks like we earned cash revenue of $880 on year 1, and that's going to be increased to cash, which is, we'll assume that's an asset or cash, $880, and also an increase to revenue for cash that we've earned right there, $880. And then at the end of year 1, we can kind of add all this up together and see how much interest we've got here. So it looks like the interest on this note for year 1 would be only 9 months, because this note was taken out on April the 1st. So January, February, and March, that's 3 months goes by, and so from April the 1st to the end of the year is going to be 9 months. So we've got $22,000, the amount of the note, times 8%, times 9/12, which is April through the end of the year. That's going to be interest that's payable on this note at as of 12/31 for $1,320, and that'll be a liability of $1,320. That'll increase that, It'll also be a reduction of equity by 1320, which is interest expense. And we're not making a payment here. We're just accruing, that is showing that we owe it as a liability, and also showing that we have the expense here. And this increase to liability and decrease to equity keeps us in balance on this accounting equation. If we'd made a payment, then we would have a reduction of cash for 1320, and showing, and also a showing of reduction of this equity of 1320. But we didn't do that. We just made an accrual of interest. Now, so year one, they want to know what's the total liability that would appear on the ABC's balance sheet for year one and year two. So year one, we have notes of $22,000, and we also have the interest that we owe for this note, which is $1320. And so the year one total liability on the balance sheet would be, related to this note, would be $23,320. Now, the next part of this, some students might call this a little bit tricky, but let's just see what we got here. Notice that I'm going to summarize year one's transactions here by drawing this line and then combine these amounts down here for totals. So I've got liabilities are at the end of year one are $23,320. That's the principal and the interest on the note. And when will the note be repaid? Well, let's see. This is a one-year note, has a one-year term. So if I borrow the money on April the 1st of year one, that means I'm going to pay it back sometime in year two. Actually, I'm going to pay it back on March 31st of year two. So what will be the liability on this note as of the end of December for year two? It'll be 0. So March 31st, like I said, is when I'm going to repay the principal and the interest of year two. So the note is repaid before end of year two, so there's no remaining liability on this note for year two. So the answer here is going to be 0 for year two and $23,320 for year one. Okay, let's look at the next one. On January the 1st, year one, ABC borrowed $165,000 cash from XYZ Bank by issuing a 5-year 8% note. The principal and interest are repaid by making annual payments beginning on December 31st of year one, and the annual payment on the note or on this loan is based on the present value of annuity factor, and that total payment will be $40,650. All I'm going to say about present value of annuity factors is when you have a present value, when you have annuity calculation, the payment that you have, which in this case is $40,650, includes two pieces. It includes a principal amount and an interest amount. Now, there, that, like I said, that $40,600 includes a principal and an interest amount. Now, the question wants to know this. They want to know the amount of principal repayment included in the 12/31 year one payment. So we got to break out the principal from that $40,650. So let's do that. So the present value of annuity factor, again, I'm going to repeat this because it's just something worth repeating. That $40,650 payment from this time value of money table is going to be principal involved in it and an interest involved in it. So we're going to break out the principal and break out the interest. Now, we compute the interest on this as follows. The loan was $165 times 8% interest, which in this case it was a 5-year note. And notice this was for the full year, so we got a full year's worth of interest. There's no so many months. There's just a full year, 12 months. So 165 times 8% means interest on this was $13,200. So that means in this $40,650, there was interest of $13,200. They want to know the amount of principal that was repaid that came out of that $40,650. So the third step would be to take the $40,650 minus the amount of interest we calculated, and that means that we'll have a principal repayment of $27,450. Let's take a look at the next one. ABC Company borrowed $28,000 from XYZ Bank by issuing a 10% 3-year note. ABC agreed to repay the principal and interest by making annual payments in the amount of $11,259. Based on this information, the amount of interest expense associated with the second payment would be what? Okay, compute the interest in year 1. That's the first thing we're going to do. Which you take the $28,000 times 10%. It's a 3-year note, right? Which is going to be interest of $2,800. Compute the principal reduction in year 1. So if we're making payments of $11,259, and we know that $2,800 of that was principal payment, or was interest payment rather, then the amount of principal payment in year 1 would be the payment we made, $11,250, minus the year 1 interest that we just calculated above here. And so the amount of principal that we're paying off of this loan is $8,459, and that's the amount that's in year 1. Now they want to know the amount of interest expense associated with the second payment, which would be in year 2. So the next thing we have to do is compute the principal balance at the beginning of year 2. So the principal balance will be the loan amount, which was $28,000, minus how much we paid on the principal, which was $84.59. That's right here, this calculation. That was the total payment minus the interest. That's the amount of principal that we paid on that loan. So the loan amount minus the amount of principal we paid in year 1 will give us the principal balance of the loan in year 2. We're almost there. They want to know how much interest was on the payment in year 2. So the payment stays the same. The payment's going to be this, what was the payment? $11,259. So it's the principal balance of the loan in year 2, which is going to be $19,541. That's the principal balance. That's what we figure right here. That was the loan amount minus year 1 principal reduction. $19,541 times 10% interest rate up there, yeah. So the interest that we're going to pay in year 2 would be $19,544, and that's the answer we're looking for. We just keep doing that over and over and over until we got all 3 years worth of the note. But they only wanted year 2's interest payment. Next, we've got the next one here, which is on January the 1st, year 1, ABC borrowed $108,000 cash from XYZ Bank by issuing a 5-year 4% note, and the principal and interest repayment repaid by making annual payments beginning on December 31st, year 1. The annual payments on the loan based on a present value factor would be $24,259.73. And now you already know that when you base these on a present value factor, that payment amount represents principal and interest. So this problem wants to know the amount of principal repayment included in the December 31st year 1 payment. So there's our December 31st year 1 payment. How much that's going to be principal and how much will be interest. So the present value factor, again, like I said, is, I'm repeating myself, but that's fine. It's the total payment there based on a present value table, table value that based on some present value money tables. It includes the principal and the interest. The total payment is $24,259.73. And when we compute the interest on this, which would be a $108,000 loan, times that interest rate, which was 4%, means that the interest included in that payment was $4,320. So to compute the principal repayment, which is what they want to know, December 31st year 1 principal repayment, that would be the $24,259.73 minus the interest that we calculated in step 2 of $4,320. And so the principal repayment in year 1 on December 31st would be $19,939.73. Take a look at the next one. This is our last one. This is a pretty involved problem here, so let's see what we got. Remember, this is our last problem, so we're almost done. On January the 1st, year 1, ABC Company borrowed $299,000 to purchase a warehouse by agreeing to a 9% 5-year note with the bank, and they're making payments every year of $76,800. $870.64, and they're due at the end of each year. So that's the payments they're making every year towards that $299,000 note. The first payment will be made on December 31st, year one, and the question wants to know how much will the company still owe on the loan at the end of year two. So here's my loan, $299,000. I took it out on January the 1st of year one. If I make my first payment of $76,870.64 on December 31st, year one, and I make my second payment on December 31st of year two for the same $76,870.64, the question is, will I owe $145,258.72 at the end of year two? You know, they want to know will the company what they'll still owe on the loan at the end of year two. And so I'm asking you, if I have a loan, it's $299,000, and I make two payments based on what the loan amount payments going to be, $76,870.64 and $76,870.64 two times, and I have you know, that I want to know is that's going to be the year two balance. I see nobody's raising their hand. Well, the answer here is no. That's not the right answer. We've got to do a lot more calculations than that, because what we have to do is we have to pull interest out of these payments. And when we pull the interest out, then we'll know how much the principal was reduced in year one. And we'll also know how much the principal was reduced in year two. And those two principal payment reductions will then give us the true correct balance on this loan. So let's do all that. So step one, compute year one ending loan balance. So we start with the original loan amount, $299. We subtract off that $49,960.64 principal repayment of year one, and I'm going to make a calculation of that in just a minute here. I'll show you. It's a two-step calculation, but I'll make it in just a minute here. And that would give us a remaining principal balance at the end of year one of $249,039.36. That's at the end of year one. So here's how I made this calculation of the $49,960.64 principal repayment. Step 1A, you compute the year one interest. So you take the $299 loan amount times the 9% interest. This will give you interest of $26,910. And then you compute the principal repayment of that. So if you had a loan that was making payments of $76,870.64, and you take the interest out of that payment, which was, in this case, we figured $26,910, then the principal repayment would be $49,960.64. And that's how much we're going to reduce the actual loan balance by to get our year one ending principal loan balance of $249,039.36. But they want to know what will be the amount you owe on the loan at the end of year two. So we got to do all this over again one more time. So compute the year two ending loan balance by taking the end of year one loan balance, which is the same thing as the beginning of year two, of $249,039.36, and subtracting out a principal repayment of $54,457.10, and this will be a calculation that I'll have to make separately. I'll call it 2A and 2B. So let's do that. And before I do that, though, the answer to this question is this. The answer is the ending principal balance at the end of year two would be, rounded to the nearest dollar, would be $194,582, not the $145,258.72. So now let's go ahead and make this next calculation here for that, where we got that principal repayment. So year two, compute the interest. So it's going to be $249,039.36. That was the year one ending principal balance times 9%, which means we're going to have interest involved or payment of in our payment of $22,413.54. The principal repayment will be the $76,870 54, that's what we're going to make this payment. Every single time we make a payment, that's what it's going to be. Subtracting off that interest that we calculated for year 2, and that means that we're going to have a principal repayment of $54,457.10, and that will be subtracted, and that's how we made that calculation. And again, the answer is $194,582, and I believe we're done. So good luck on the test.